Is it just going to be overall much more difficult to invest as volatility gets underway?
I think there's certainly a chance the volatility is going to be higher. I mean, I've seen a lot of research in the last few days suggesting that we don't need to worry too much about Omicron because deaths are not rising despite the sharp pickup in cases. But when I look at the hospitalization data, both in the UK but also in Europe and in the US, it's rising pretty sharply now. And okay, in the UK, the ICU data is not going up, but in places like Italy and Spain and France, it has been rising, and likewise in the US. So it seems to me a little bit premature to say that we don't need to worry too much about Omicron just yet. So for me, that's clearly the kind of key risk that investors are potentially being a little bit complacent about.
Okay, so maybe complacency around Omicron. Mike, we saw that tick up in yields, jump up in yields for the US 10-year, above 1.6%. What does that signal to you? And where is the pain point, do you think, in terms of yields and the impact on equities?
To be honest with you, I mean, I think equity markets could withstand a 10-year Treasury yield at 2, maybe even 2.5% without too much trouble. I think if we got to 2.5% in a matter of days, then I think that would hit the PE on some of the more expensive stocks, certainly hit the some of the more defensive stocks as well. But I don't think you're going to see a very rapid move higher in bond yields. Our base case is that, you know, if Omicron turns out not to be a problem, that bond yields would gradually move higher and the equity markets would take it in its stride. It might lead to some PE derating, but the earnings would offset that. So to me, the bigger risk is much more if people are being complacent about Omicron's impact on the economy than rising bond yields posing a threat to equity markets.
Mike, what's more difficult to read? Is it China or inflation?
Well, I think the timing on inflation is very hard to say because, you know, there's this question mark around how long the supply disruptions are going to remain in place and therefore how long it's going to take for this goods inflation to fade. The other thing, of course, is that if Omicron is not a problem, which is a big if, but if Omicron turns out not to be as big a problem, then the labour markets look very tight, particularly here in the UK, but also in the US. And that could lead to more sustained wage pressures than I think some people are expecting. And with that, higher core inflation over the next few years than I think the market's expecting. But I think the key point there is I don't really view that as a problem for the equity market, because if that causes interest rates to go up a little bit quicker than expected, then I think in the economy as a whole, both in the US and the UK, is not that exposed to higher interest rates. Because if you compare with 2007, back in 2007, about 20% of mortgages were adjustable rate in the US. Today, it's only about 5%. And in the UK, the number of people who are fixed also has risen significantly. So I think the economies are broadly much less sensitive to higher interest rates today than they were in the past.
Mike, just to draw you out on the part of the question around China that Fran posed to you, do you see the relative underperformance of Chinese equities last year as an opportunity? Is there enough clarity now in China to add exposure there?
Well, so again, I think the big risk is Omicron, because if their zero COVID policy doesn't work against this much more infectious variant, then that could pose problems for China. If Omicron turns out not to be a big problem, then I think that there's enough bad news already in the price for Chinese stocks after the bad year we had last year. And with the easing that we're seeing, it should be a pretty good year this year. So ultimately, it's so hard to keep saying this, but it all comes down to Omicron. If Omicron's a problem, then I think markets look a little complacent. If Omicron proves not to be a big problem, then I think things are going to look pretty good.
So, Mike, overall, what are the chances of actually the Fed tapering going on without market tantrums?
Yeah, I don't think that tapering is going to be a big problem. As I say, I think, you know, the risk is that bond yields move higher. That weighs on some of the defensive stocks. It might derate the PE on some of the expensive tech stocks as well, but that it would be beneficial for things like financial stocks and some of the sort of cyclical value stocks that tend to benefit in a rising bond yield environment. For the market as a whole, I think that it isn't too big a problem, although, as I say, it may mean that you want to be selective within that. So, yeah, I don't think tapering is going to be a major problem.
Mike, just briefly, you talked about the relative resilience of households and corporates to a higher rate environment. What about household balance sheets? Do they stay relatively strong in 2022? They were so important last year to kind of sustain this consumption that we've seen. Does that household consumption start to be eroded this year?
Well, so they still start 2022 in a pretty good place. The data we've got looking at the US suggests that, okay, it's not as high as it was in April of last year, but savings are still significantly higher than they were pre-pandemic. And so consumers have still got money left to spend. The other thing, of course, we know is that even if Omicron does prove to be a problem, that tends to mean that people are stuck indoors, they save money, and then so it kind of delays the spending rather than necessarily mean that it doesn't happen at all. So, maybe that's what markets are focusing on at the moment. But certainly household balance sheets going into this year still looking pretty strong, in a pretty strong place, albeit not quite as strong as they were back in April of last year, which was the peak saving.